I want to start with a confession. There have been exactly 4 moments in my investing life, 4 across decades of watching markets breathe and collapse and rebuild, where I looked at the totality of what was happening and said quietly to myself, this is the one. This is the moment that separates the people who will be fine from the people who will spend the next decade wishing they had paid closer attention. I'm not someone who says that lightly. I've watched investors get burned by false urgency too many times to add to that tradition carelessly. Most moments that get labeled once in a generation are nothing of the kind. They're just uncomfortable. Uncomfortable is not the same as historic. But there is a category, a genuinely rare category, of moments where the combination of factors at play creates something structurally different from ordinary market volatility, where the decisions made in a relatively short window of time carry consequences that compound for a decade or more in either direction, where the difference between being prepared and being unprepared is not measured in percentages but in the fundamental quality of your financial life. I believe we are in one of those moments right now, and I want to use every minute of this video to explain exactly why I believe that. Not with hype, not with urgency theater, but with the same calm and methodical reasoning I've applied to every major inflection point I've navigated. Because I think you deserve that. I think you deserve an honest, grounded account of what I'm seeing, what it means historically, and what the framework is for positioning yourself correctly, not just for the next few months, but for the next decade. That's what this video is. Let's get into it. The word historic is one of the most abused words in financial media. Everything is historic. Every correction is the worst since some previous correction. Every rally is the strongest since some previous rally. The superlatives come so fast and so constantly that they lose all meaning, and the people who consume them become desensitized to the signal that the word is actually supposed to carry. So let me be precise about what I mean when I say historic, because I'm using it in a very specific technical sense, not as a synonym for dramatic or scary. A moment is historically significant in the investment sense when it produces a structural change in the distribution of future returns. When the decisions you make, or don't make, during that window have a materially different impact on your long-term outcome than the decisions you would make in a normal period. Most of the time, markets are operating in a relatively normal range. Prices are roughly where the underlying fundamentals would suggest they should be. Sentiment is somewhere between mild optimism and mild pessimism. The distribution of future returns from any given entry point is relatively ordinary, probably positive over long horizons, with normal volatility along the way. But occasionally, not often, not predictably, but with enough historical regularity that you can study the pattern, something disrupts that equilibrium. A confluence of forces creates a situation where the gap between what assets are priced at and what they are fundamentally worth becomes very wide, where fear has driven prices significantly below where rational, long-term analysis would put them, where the people who are selling are doing so not because of a change in the underlying value of what they're selling, but because of a change in their tolerance for discomfort. When that happens, and I want to be very explicit about this, it creates an asymmetry. The downside risk for the long-term fundamentals-grounded investor becomes significantly smaller than the upside potential. Not zero. There is always downside risk, but the asymmetry shifts decisively. And that shift in asymmetry is what I mean when I say historic. Not that something dramatic is happening, though something dramatic clearly is, but that the structural positioning of the patient, principled investor, relative to the reactive, fear-driven participant has become unusually favorable. That is what I'm seeing right now. And that is what I want to explain. Let me describe what's actually happening in the environment right now, because I think most of the narratives circulating are either too simple or too catastrophist to be genuinely useful. Here's the honest picture as I see it. We are experiencing a genuine geopolitical disruption with real economic consequences. I don't want to minimize that. The forces at play, rising energy costs, supply chain pressure, policy uncertainty, the potential inflationary dynamics, these are real. They have real effects on real businesses and real households. Dismissing them as pure noise would be intellectually dishonest. But here's the part that gets consistently underweighted in the current narrative. Real disruptions and permanent structural deterioration are not the same thing. We have experienced genuine disruptions many times across the history of modern economies. Wars, energy shocks, financial crises, technological transitions, pandemics. Each of them was, in the moment, genuinely serious. Each of them produced real hardship for real people. Each of them was accompanied by a confident and widely circulated argument that this time the damage was different, deeper, more permanent, more fundamental than what had come before. And what happened in virtually every case when you zoom out to the relevant investment horizon? The productive capacity of the underlying economy proved far more resilient than the fear-driven narrative had suggested. The businesses that were genuinely strong, that had the fundamentals, the positioning, the balance sheet fortitude to survive the disruption, not only survived but often emerged in a stronger competitive position than before. And the investors who held their framework through the noise captured returns that the fear-driven sellers forfeited permanently. I am not saying this cycle will be identical to every prior cycle. It won't be. Every disruption has its unique characteristics. I'm saying the underlying mechanism, the pattern by which fear-driven repricing creates opportunity for principled long-term investors, is consistent enough across history to be genuinely instructive. And right now, that mechanism is active, in a way I haven't seen for quite some time. I want to shift the time horizon deliberately now, because I think most of the conversation happening around the current environment is anchored to the wrong timeline. People are asking, what's going to happen in the next 3 months? What happens if oil stays elevated through the summer? What does the Fed do in the next 2 meetings? Will there be a resolution to the geopolitical situation by year end? These are all reasonable questions. I have views on some of them, but they are the wrong questions if what you're actually trying to do is build wealth, real wealth, the kind that materially changes your life over a meaningful time frame. The right question, the one that the evidence actually supports, centering your thinking around, is this: what is the most probable state of the world's productive capacity in 10 years? And what assets purchased today at current prices represent the most favorable risk-adjusted entry points for capturing that decade of productive growth? When you ask the question that way, the current noise looks very different. Because here's what 10 years of market history consistently shows. Almost none of the short-term concerns that dominate any given moment turn out to be the determining factors in long-term investment outcomes. The geopolitical situation that seems so overwhelming today, the energy price spike that feels so structural and permanent, these things do not typically prove to be the decisive variables for a patient investor with a 10-year horizon. The decisive variables, over and over and over again across long historical windows, turn out to be the quality of the underlying businesses you own, the price you paid for them relative to their fundamental earning power, and the discipline you maintained in holding them through the period of maximum discomfort. That's the formula. It's not exciting. It doesn't make good television. It doesn't generate the kind of urgency that drives social media engagement. But it's what the evidence actually supports when you look at it honestly over the relevant horizons. And right now, the intersection of those 3 variables is unusually favorable for the patient investor who understands what they're looking at. The current disruption is producing genuine pricing opportunities in quality businesses. Businesses whose underlying productive capacity has not deteriorated materially, but whose prices have been driven down by fear-driven selling that doesn't discriminate carefully between the strong and the weak. The entry points available to a disciplined investor today, in certain categories of businesses, in certain sectors, in certain parts of the market that the fear narrative is hitting most indiscriminately, those entry points look through the decade lens like what the long-term evidence suggests they are. A window, a genuine, historically significant window. Let me address something directly because I think it's an important distinction. I've been describing the current environment as historically significant, as representing a genuine wealth-building opportunity of the kind that doesn't come around frequently. And I want to explain why I think that, rather than simply asserting it, because I think you should demand that rigor from anyone making a claim of that magnitude. What makes any given window genuinely significant, rather than just another correction in an ongoing series of corrections, is the combination of factors that are simultaneously present. There are moments of pure market volatility, price dislocations driven by sentiment shifts, by technical factors, by momentum dynamics. These create opportunities, but relatively ordinary ones. The repricing is real, but not particularly deep. The fear is present, but not particularly extreme. The window opens briefly and closes relatively quickly as the sentiment normalizes. And then there are moments where you have something more complex, where genuine fundamental uncertainty, real changes in the economic environment that require genuine adaptation, combines with sentiment-driven fear to produce a level of repricing that goes meaningfully beyond what the underlying fundamentals would justify, where the narrative becomes so dominant and so negatively oriented that it drives behavior that is structurally irrational from a long-term perspective. Those moments are less common, and they are more consequential in both directions. They create more genuine opportunity for the investor who is prepared, and they create more genuine damage for the investor who is not. The current moment has the characteristics of the second category. Not simply because the geopolitical situation is serious, it is, but because of how that seriousness is interacting with the existing psychological state of the market, the existing levels of uncertainty, the existing degree of narrative dominance. What we have right now is a genuine disruption, layered on top of a market that was already navigating significant uncertainty, layered on top of a media and social environment that amplifies fear with extraordinary efficiency. That combination, when I look at it through the lens of historical pattern analysis, is exactly the combination that has historically produced the most significant opportunity windows. Not comfortable ones, not obviously labeled ones, but genuinely consequential ones. And I want to make sure you understand what that means in practice. Here's the thing about windows. They have a defining characteristic that is both obvious and consistently underestimated. They close. Not slowly, not with warning, not with a clear announcement that the opportune moment has arrived and you should act now. They close when sentiment shifts, when the fear narrative loses its grip and the more optimistic narrative reasserts itself, when the patient capital that has been quietly accumulating during the fearful period has done enough accumulating that the supply-demand dynamics begin to shift, when the first signs of fundamental resilience become impossible for the market to ignore. At that point, the point when the window is clearly visible, when the opportunity is obvious in retrospect, the opportunity is largely gone. The prices that reflected maximum fear are already history. The entry points that made the decade-level asymmetry so compelling are no longer available. This is the cruel arithmetic of market cycles. The best entry points exist at exactly the moments when acting feels most dangerous, when the narrative is most frightening. When the people around you, some of them intelligent, some of them credentialed, some of them with genuine experience, are making confident arguments for why this time is different and why caution is warranted. The preparation I'm talking about today is not primarily about having a shopping list. It's not primarily about knowing which specific assets to buy or in what proportion. Those are important, but they're downstream of something more fundamental. The preparation that matters is mental and structural. It's about having built, before the window opens at maximum width, a framework clear enough and sturdy enough that you can act from principle rather than from the emotion of the moment. It's about having answered in advance and with specificity the questions that fear makes it almost impossible to answer clearly. What is my actual time horizon? What do I believe about the long-term productive capacity of the businesses I own? What evidence would genuinely change my view? And what events, however frightening they feel in the moment, are I explicitly committed to not allowing to drive my decisions? If you can answer those questions, if you've done that work before the peak of the fear rather than during it, then a moment like this one stops being paralyzing and starts being what it actually is. One of the few moments in a decade where the math is clearly, structurally in your favor as a long-term investor. I want to ground this in something concrete because principles without evidence are just opinion. Here is what the long-term historical record shows when you look at it honestly across a wide range of disruptive periods. Every major disruption of the last century, every war, every financial crisis, every geopolitical shock, every period of elevated inflation and economic uncertainty, produced a moment where the dominant narrative was that things were fundamentally different this time, that the damage was too deep, that recovery would take too long or might not come at all. And in virtually every case, the investors who maintained their discipline, who held quality productive assets through the disruption rather than exiting into cash at the point of maximum fear, captured returns that were dramatically superior to the investors who prioritized short-term comfort. Not in every individual case. Some individual businesses didn't survive. Some specific bets were wrong. The principle is about the aggregate, not about perfection. But at the level of principle, when you look at the behavior of diversified portfolios of quality productive assets across long historical windows, the evidence is about as clear as evidence gets in an uncertain domain. Exits driven by fear of short-term disruption are almost never vindicated by subsequent long-term outcomes. The cost of sitting in cash through a major disruption, the returns forfeited while waiting for clarity that arrives too late to be useful, has historically been dramatically higher than the cost of maintaining productive asset exposure through the same period. This is not a controversial observation among serious students of market history. It is perhaps the single most consistently replicated finding in long-term investment research. And yet, in practice, in the real-time experience of actually being inside a disruption, when the fear is genuine and the narrative is loud and the discomfort is real, this finding is extraordinarily difficult to act on. That's the gap. The gap between knowing and doing, between understanding the principle intellectually and having the internal infrastructure to act on it when it's actually hard. Closing that gap, building the mental framework that makes it possible to act from principle during periods of maximum noise is, I believe, the most valuable thing an investor can do. It is worth more than any specific piece of information, more than any specific stock tip, more than any specific market prediction, because the principle applies to every subsequent cycle, not just this one. Every difficult moment you encounter over the rest of your investing life. Before my final thoughts, 3 quick things. First, I've put together a framework document that covers exactly how I approach periods like this one, not a list of assets. A thinking process, a structured way of evaluating your own situation, your own time horizon, your own positioning relative to the opportunity that a moment like this represents. It's in the description. It's completely free. I'd encourage you to read it carefully and honestly. Second, if you want to go deeper on building the kind of long-term investor mindset that makes these moments navigable rather than paralyzing, the kind of structured framework that holds under real pressure in real time when the fear is genuine, I've built a community of serious, principled, long-horizon investors around exactly that work. People who are committed to doing this properly. The details are in the description. And third, if this conversation is useful to you, if this is the kind of clear, honest, framework-driven thinking you want more of, subscribe. Because the next difficult moment is coming. I intend to be here for it. I want to be here for you when it does. Let me leave you with this. I opened this video by saying there have been exactly 4 moments in my investing life where I looked at the totality of what was happening and said, this is the one. I want to tell you what those moments had in common. Not in terms of the specific cause. The cause was different each time. But in terms of the experience of being inside them, every single one of them felt from the inside like the wrong time to act. Every one of them was accompanied by a loud, credible, widely believed narrative for why this time the damage was structural and permanent. Every one of them produced a level of discomfort in me, personally, in my own gut, at 3 a.m. when the numbers were moving and the narrative was loud, that made the principled path genuinely difficult to walk. And every single one of them, in retrospect, turned out to be exactly what the historical pattern had suggested it would be. A window, brief, uncomfortable, clearly labeled, but only in hindsight. A window where the preparation I had done in calmer moments either paid off decisively or revealed where it had been inadequate. What I'm describing right now, the current environment, the current confluence of factors, the current gap between fear-driven pricing and fundamental reality, has the characteristics of those moments. Not identical. Nothing is ever identical, but structurally similar in the ways that matter most to a long-term investor with a clear framework and the discipline to apply it. The title of this video is "History is About to be Made." I believe that, not as a content strategy, as a genuine conviction built on decades of studying how these moments work and what they produce for the people who navigate them correctly. The last big wealth opportunity of the decade is not a prediction. It's an observation about structure, about the rare alignment of factors that creates genuinely favorable long-term entry conditions, about the window that is open right now in ways it was not open 12 months ago and may not be open 12 months from now. What you do with that observation is entirely up to you. But I hope I've given you a clearer, more honest, more grounded framework for thinking about it than you had before. Get ready. I'll see you in the next one.